When we're talking about advanced capital asset pricing model, there are often cases where we have to make adjustments to, well, especially things like the beta. And that's especially true if there's going to be a change in the capital structure. It's always true if there's going to be a merger, an acquisition, because when we're buying another company, we're going to change their capital structure, quite often make it a lot like our own. And so that means we need to use a couple of extra tools that we haven't yet been introduced to. One of the things that we'll look at is adjusting beta for a difference in capital structure. This takes into account the fact that the capital structure that we're using is going to change with the amount of leverage. All of the volatility for a company's beta comes from the equity part of the cost of capital. And so if we have a company that's made up of mostly debt, then the amount of the volatility is going to be understated. If we use more debt, then that amount of volatility will increase. The idiosyncratic risk will increase. We'll also take a look at estimating beta for a new company or a company that's going to operate in a very different way, using the calculations that we introduced earlier in the course. We'll start off with a little bit of data that we'll use throughout the examples here. We have a risk-free rate that's given of 7%, a market premium of 5%. We'll start off with a beta for the company that we're going to use of 1.2, a weight of debt of about 30%, so a weight of equity of about 70%, and a cost of debt of 9%. So if we're going to calculate our cost of equity, it's essentially just going to be that 7% plus the market premium, the risk premium, times the beta, or it'll be 13%. And then our weighted average cost of capital here that we're going to use in the examples that follow, about 10.7%. Based on we have a 40% tax rate, so 30% weight times 9% debt times 1 minus 40% for the corporate tax shield factor, and about 70% times the cost of equity. When we talk about the target beta, how is that different from the beta that we've seen before? For the company that we're taking over, or for a company that we're restructuring, we need to be able to calculate an alternative beta. And that's where the fundamental difference here. Where did we get that 1.2 in the previous example? Well, an American academic by the name of Robert Hamada recognized that the firm's beta, and something we call the asset beta, the raw beta, that company beta reports the idiosyncratic risk of the firm, of all of the assets of the firm, or all the sources of capital of the firm, including the debt and equity. The uncertainty related to debt is zero. The return to debt is always going to be exactly the same. So all of the uncertainty must therefore load onto the equity side of the cost of capital calculation. So only equity generates the risk. So in order to take the asset beta, or the all equity beta, the asset beta, or the raw beta, or the leveraged beta, to get the target beta, we have to unlever the beta to get an all equity or an unleveraged beta. The calculation before we account for tax is just to take the published beta, the one that we got for the company, and take the equity over the debt plus equity ratio and multiply that by the forecast one. So to get the unleveraged, we take the published, be clear about this, we take the published beta, we multiply it by the leverage factor, and that will give us the unleveraged or the equity beta. Once we have that unleveraged beta, we can then re-leverage it to the target debt-to-equity ratio that we're going to use afterwards. If we decide we're going to fund our business in the future with all equity, then the unleveraged beta would just be the target beta. If we're going to have 30% debt, we're going to take that into account. And to calculate the target beta, we take the unleveraged beta that we just calculated, and we multiply it by 1 plus the debt-to-equity ratio to get our target beta. Now, taxes are also going to have an effect, because the tax creates that tax advantage of the tax shield. So for a fully adjusted version of this, to get the leverage beta, we would start off with the unleveraged beta that we had before, multiply it by 1 plus 1 minus the corporate tax rate times the debt to equity ratio. And then to create the unleveraged beta, we'd take the leverage beta and we'd multiply it by this factor here. So essentially this is the formula that we're going to use. You don't have to get too caught up in the calculations. An example really helps though. And you'll see there's a spreadsheet that I provided. In fact, there's a whole separate document that's in the VIU Learn material that takes you step by step through this. Includes not only this Hamada exercise, but another worksheet that's provided by Aswath Damodaran that's embedded in the PDF document that I provided. If we take a look at the actual spreadsheet for this that's provided, you can see how this works. Imagine we've got a problem. We have to figure out what the beta would be for a brand new company that's about to go public. We don't know what their beta is because they've never traded before. We can't calculate it based on their stock trading history. But we know they're an awful lot like 3 other companies in their industry. They're a lot like Home Depot, Lowe's, and a company in Seattle called Building Material Holdings. The published betas, the raw beta, for these companies, for Home Depot, 1.03, 0.9, and 0.7. We also know the debt to equity ratios for these 3 firms. Home Depot has a 76% debt to equity ratio. Lowe's has 41%, and Building Materials is 138% of their equity. So the tax rates for these companies, because they're different size businesses, the bigger ones have 36% marginal tax rate, and Building Materials has a 29% marginal tax rate. We calculate the unleveraged beta using the formula that we talked about earlier. We're going to take the raw beta, we're going to divide it by 1 plus 1 minus the tax rate. So 1 plus 1 minus 36%, and then we're going to multiply it by the debt to equity ratio, the information in C5. And so that tells us that for Home Depot, if they were an all-equity company, if they had no debt, their beta would be 0.69. If Lowe's was an all-equity company, they would be 0.713. And if Building Material Holdings, their beta would be 0.354. We just used the raw number. We didn't bother doing any fancy weighting. So we took the average of these 3 companies, and we said that's the average for the industry, for the peer group that we know it. And for our new company, therefore, an all-equity beta or an unleveraged beta would be on average about 0.586. Now, next thing that we do is we want to figure out how much debt we're going to use in our new company. If we decide that we're going to have 0% debt, if we're going to have an all-equity company, then the target beta is going to be 0.586. If we decide we're going to have a 50% debt to equity, we start off with the unleveraged beta and we re-leverage it. And remember, to re-leverage, we take the information that is in cell E12, the unleveraged beta, and we multiply it by 1 plus 1 minus the tax rate, and then multiply that all by the target debt to equity ratio of 50%. And so that's exactly how we do this. You see the beta of our company is proposed to be about 0.774. So if your client said, I want to do an IPO, I need to calculate the cost of equity, can you help me with the beta? This is exactly how we would do it. We'd say this is the average based on the other companies that are operating in the industry. And so that was Robert Hamada's contribution. And essentially, that's something that you need to know about, because if you were to use the historical beta for a company that's being restructured, or if you're taking over another company and you plan on restructuring their capital, their historical beta would be the wrong one. And since the beta can make a big difference in the overall value of the company, it makes a big difference in the cost of equity according to CAPM. It's a mistake that we don't want to make. And so back to our PowerPoint presentation. So we know from our own experience of understanding or looking at beta already that the beta is a measure of the firm-specific, the idiosyncratic risk. And we can understand it by comparing it to the variability of the company's returns relative to a relevant index, like the Standard & Poor's Index or the Russell Index or the Toronto Stock Exchange's S&P TSX Index. So we can calculate that by doing a regression. If we run a regression, we can essentially see what the slope or the characteristic line for that particular company is going to be, and that'll give us an idea of what the beta should be. And for this, we're going to need a little bit of data. You'll actually see on the last page of the tutorial video, this particular example is provided for one company. In this case, it's Teck Resources, and for this one, we used Teck's share price on the New York Stock Exchange, and we downloaded that information on a month-by-month basis for 60 months. So we have 60 data points, 60 months, and these were the share prices for this company over that entire period. We're working backwards from June of 2012 and go back for 5 years or 60 months, and without even having done any calculations, you can see there's a lot of variability. It's, the most recent month was $31 a share, $40, $29, $50, $60, and then back here in 2009 it went down to about $3 per share. So the company's share price, we know already, is quite volatile. We don't have to do any calculations at all to see that. The comparison is going to be with the Standard & Poor's 500 index, and here we can see the index values, the index numbers, for each of those same 60 months. A certain amount of volatility, but not nearly as volatile as our company. So the next thing we do once we've downloaded those two sets of information from our source, and in this particular case I used Yahoo Finance, and you can also get that information from investing.com. In fact, you'll notice for your company that is one of the exhibits. That data is one of the exhibits in your spreadsheets. And so we have next to do the calculation of the monthly return. The monthly return is given in the next column, and it is just essentially, in fact, let's take a look over at the spreadsheet. I'll show you exactly how we've calculated that. So go back to the tutorial spreadsheet, and the very last tab has got that information. So I'll make that just a little bit bigger. So we have that same information, and you can see in that next column, I've said I'll take the beginning of the period, the end of the period minus the beginning of the period divided by the beginning of the period. So end of period minus beginning divided by the beginning. And so I take 31 minus 29 divided by 29, and that says that during that one period, my rate of return was about 6%. That number makes sense, so it looks like I've done that one correctly. Now I just copy that particular equation down for this entire column, and then I copy it for also exactly the same formula for the S&P column. So now I can see the percentage change, the percentage of return for the stock and for the index for each of those 60 months. Well, in this case, in fact, if you go down to the bottom, you'll see I'm missing the first month because I've only got 59 months, and I can't compare myself against the month that I don't have data for. Now, the only other thing you have to do in order to calculate the beta, to do it the simple way, is to use a slope function. Now, the slope essentially says, tell me what the slope is, and for this we're going to have to give it not the share prices, but those return columns. And the first column for the Y column, the stock column, is going to be column C2, well, from cell C2 to C73. Those are my data points for tech. And then for the index, I've got my X values, F2 to F73. And that tells me that I have a beta of almost 3.3. Now, remember, a beta of 1 is normal. Beta of 2 is very high. 3.2, 3.3, does that make sense? Well, actually, it does for this company. And when I compared it, when I did this particular comparison, it turned out that my numbers were just about perfectly right. And they'll be off by a little bit because everybody calculates betas a little bit differently. But in a simple calculation of beta, 3.3 is about right. For every 1% that the market moves, the company's stock moves about 3%. In fact, I plotted it just for fun. We use the scatter diagram feature in Excel. And for each of the months, for example, for 2012, for tech resources, on the y-axis we have a movement of 6%. So we've got a 6% movement for June of 2012, and we've got a 0% movement in the Standard & Poor's index. And so we can plot that onto the line, and that becomes one of these dots. And we do that for each of the months. And when we've got all of those dots scattered, we can say, gee, it kind of looks like there's a trend here. In fact, you can click on the trend line function in the chart program, and that will draw that trend line. And that trend line is the characteristic line. That's the slope of that line is our regression. So that's how we would calculate, or that's how you could calculate the beta for a company if you don't have a beta that's been published. That's where we... Sure, is it? Right. Well, that is a good question. Your beta gets better the more data that you've got. And so if you have 60 months, that's probably a full set of data. But what if a company's only been publicly traded for 25 or 30 months? Can you still do a beta? Well, the answer is yes. It's not going to be as good as a beta with more data points, but it's still going to be it's the best that you can do. You can also do a beta by taking weekly information over a shorter period of time. You could even theoretically do a beta on a daily basis. However, we generally find that there's a lot of noise that is in stock prices. And so if you use too short an interval period, if you use daily information, you end up with a beta that is relatively consistent, but you have a low R-squared value, if you remember back to talking about regression. And so we tend to get the most stable results when we use monthly information. So that's why I've used monthly in this case. And you'll see the Bloomberg on their terminal, their default I think is 26 weeks of weekly information, which to me makes no sense at all. So if you've got 30 months, or if you've got 25 months, and that's all you've got because the company did an IPO only 2 or 3 years ago, well, you'd use the information that you've got. Okay? And a good question, very good question. It's one that we struggle with. It's certainly, you go to a conference and you listen to a bunch of professors talking in the bar. They're not talking about football, and they're not talking about what was on TV or anything like that. They may end up, you may hear they're talking about beta. And as far as it goes, that's pretty much all the material that we've got for this course.